the people that are actually holding on a lot of cash and the people that are looking to make moves into assets are probably going to have the best deals ahead right here, with both leveraged opportunities when we look at borrowing costs and also having the liquidity when asset prices go on sale. So I definitely think this is the position of power, and that's why I haven't been dropping a lot of videos here, ladies and gentlemen. It's already shaping up to be a very interesting week, and ladies and gentlemen, it is only Tuesday and we're only 4 days into the month, as Donald Trump's meeting with Zelensky did not really go over well with the public. Now, with that being said, I do think we'll see a deal done in the next few weeks or next few months, and I do think we will see some sort of peace treaty over the next year. Now, if that wasn't enough, we have tariffs going in place for Mexico, Canada, and China. 25% tariffs on Mexico, 25% tariffs on Canada, an additional 10% tariffs on China, which brings it to 20%. Now, we're definitely getting market uncertainty, and anytime the market is uncertain, well, we know it's going to be volatile. Now, this is something we've talked about over the last year. As you guys can see here, 6 months ago, I was comparing the history of 2007 to a similar history that we're in as of today. History doesn't always repeat, but it can definitely rhyme. And there's definitely some rhyming with me personally when I look at a Fed tightening, a new administration coming in, political tension, and possible asset bubbles we can be looking at, to something similar to the dot-com bubble with a combination of 2007. And as I stated, I don't think it's going to happen identically, but I do think there is some rhyming here, and we're starting to see valuations actually contract here, which was one of my things I've talked about on the channel, that I do think we could see between a 25 to 35% correction over the next couple of years, with the end of 2005 to into 2006 being the brutal time and a possible market bottom. Comparing that to maybe we're looking at 2007, where 2009 was the actual bottom in this market, and I'm comparing that to where we are today. And a little over a week ago, I was saying it's time to start building some cash here. The new Trump tariffs are definitely going to spark some panic here and a possible major market sell-off, as we started seeing the VIX now breaking over a major moving average here, and we're starting to see the S&P 500 having a harder and harder time reaching newer heights, and we've actually dipped about 5% from recent highs, which is going to lead me to my next point of the labor markets and consumer sentiment, two of my major concerns here. Now, when we think about a market starting to dip down here, we start thinking about political tension, tariff fears. Obviously, this is going to impact consumer sentiment, which now plummets to a 15-month low. What is the problem with consumer sentiment hitting a 15-month low? Well, if consumer sentiment keeps going into the gutter here, the two strongest parts of our labor market is government jobs and service-based jobs. So if sentiment keeps crashing, obviously service jobs are we're going to start seeing some layoffs in service jobs, because people are not going to be confident to go out and spend money, which then will trickle down to our service-based industry, which is 70% of our economy. Now we line that up with our labor markets when we talk about government spending, and we throw the fact that Doge is now making cuts on government jobs. And while they're making cuts on government jobs, there may be some of the biggest scams that we've ever seen in things called NGOs. I definitely think this is heartbreaking for individuals losing their job, and I do think sentiment with these cuts are going to impact the labor markets extremely hard as we get into the later part of this year. But I also think there has been some fraudulent things that are going to get uncovered that are going to shock a lot of people here. But only time will tell as the truth starts to unfold here, and maybe these cuts are going to be nothing. Maybe it's going to do more damage than good. Maybe these tariffs are going to do more damage than good. And so that's going to lead me to what I think is going to happen in the market here. We all know that Buffett's been hoarding a tremendous amount of cash, and he believes that tariffs are an act of war. This is probably going to be pretty violent before it gets better. And with record cash that he's sitting on the sidelines with, I definitely think the opportunity is cash right now. I'm not seeing great entry points with a lot of the mega tech companies. And if they're going to sell off, everything else is going to sell off. So just because you think you're seeing a deal in the market, unfortunately, when the chips fall, they all fall together, and then they get separated once logic kicks in and valuations get to a reasonable level. And I'm just not so sure we're there yet. And I think with Buffett hoarding cash and coming out with this type of statement, he obviously thinks there's going to be better entry points as well, because as we all know, Buffett's usually not a verbal speaker when it comes to markets, but I think this is pretty transparent for Buffett. Now, with all this taking place, we're seeing a flock to safety with gold, and we're seeing a flock to safety with treasuries, where now we're starting to see that 10-year treasury come back down to about 4%. when it was reaching as high as 4.75%. So we're having pretty strong volatility within the treasury market, and this is going to be good for anybody that needs to refinance, anybody that is maybe looking to possibly purchase a house. If we start seeing this 10-year treasury kind of come down here, we see consumer sentiment go in the gutter. For me personally, 2025 into 2026 is a accumulation of cash at this point in time. The Atlanta Fed forecast coming in with negative 3% GDP. Now, we've had negative GDP in the past, and that did not lead to a recession. What is going to lead us to a recession is going to be the combination, in my opinion, of negative GDP, earnings not coming in as strong as anticipated, and unemployment ticking up. And I believe that's going to come in the form of government jobs and service-based jobs as well. As I stated before, I definitely think we're in a gig economy where you can create multiple jobs from the comforts of your own home, whether you want to drive Uber, Lyft, or Uber Eats. And once those consumers stop spending on those items, I really think this is going to hit consumer sentiment even harder, and is also going to cause service-based layoffs. So personally, what I'm starting to look at here is shorter term treasuries, still trying to get anywhere between 3 to 5% returns on the shorter term treasuries, still building my cash position. I would also be interested in looking at something like maybe a JEPI. As we saw over the last month, the S&P 500 is down roughly 3.5%, but JEPI is only down 0.39%, and every month does pay a dividend here. Now, if you're not familiar with JEPI, these are covered called strategies. The reason why I'm starting to look at these is because I do think the premiums are going to be much higher on these. They're professionally managed. The beta to the downside is lower. So there's multiple reasons why I'm actually looking at something like a JEPI on a big enough dip. The volatility will create a little extra income to offset the price of the ETF. And then if I topple that with going overweight on the 0 to 3 month treasury, what that's going to do is create a lot of yield in my portfolio, lower the beta because most of my money is going to be in a 0 to 3 month treasuries, and maybe 30 to 40% goes into something like JEPI with individual names that I'm picking along the way at very, very low averages, I think could actually outperform the market this year. So that combination is actually starting to interest me personally. That's what I'm starting to see. I think the volatility gives opportunity for something like a covered call ETF strategy to outperform markets because of the premium on those covered calls, and the fact that if they do fall, it's probably not going to fall as much as the actual market. So meaning if the market decides to explode up, you do get some exposure here with something like JEPI or SPYI. But the true opportunity is going to be the premiums getting more and more expensive because of the volatility and people hedging their bets, which then you can collect a higher monthly premium with something like this. And then you're also collecting a monthly premium with a 0 to 3 month treasury bond or treasury ETF. So that's kind of where I see the opportunity longer term. I think this will actually outperform over the next, call it 3 to 6 months until we get some more clarity. I don't think you're going to get a tremendous amount of price appreciation, but I do think you'll get a healthy dividend every month to offset the volatility. As always, guys, this is where I'm standing for right now. I try to do my best to kind of give you guys strategies that I'm personally looking at, personally using. Now, this is not a recommendation to buy or sell stocks. This is just a strategy I'm personally starting to look at for myself. As always, ladies and gentlemen, appreciate your time, and we will see you all in the next one.